So welcome to this press conference on the results of the comprehensive assessment of the 130 largest banks in the euro area. Let me introduce everyone before we proceed to the presentations and the questions and answers. My name is Connie Lotzer. I'm the Deputy Director General of Communications. To my right is the ECB Vice President Victor Constâncio, and to his right is the Chair of the Supervisory Board, Daniel Nouy. Mr. Constâncio and Ms. Nouy will now present the results to you before we take your questions. With this, let me give the floor to Mr. Constâncio.
Well, welcome to this press conference about the results of the comprehensive assessment. And at the start, let me make 4 points. The first one is to underline that the comprehensive assessment has unique features. Namely, it combines an asset quality review with a macro stress test, which indeed is a very unique feature. Second, it disclosed very detailed methodological manuals for both components of the exercise and for the respective quality control of banks' reporting. Third, the implementation of the exercise involved many thousands of experts, including about 5,000 of independent private firms. More than 800 individual portfolios were in the scope of the exercise, representing almost 60% of total risk-weighted assets of the banks and implying the analysis of the credits of 119,000 borrowers of the banks. And fourth, the exercise provides, with unprecedented transparency, a vast array of data from banks' balance sheets and from the final results. The massive nature of the exercise deserves, I think, to be acknowledged. And its results are credible because they stem from an accurate methodology, from a rigorous implementation, and from a demanding central quality control of the results. The second point I wanted to make is that the conclusion of the exercise was preceded by a significant amount of front-loaded measures taken by the banks. Since July last year, SSM banks have undertaken various measures to strengthen their balance sheets by more than 200 billion euros, including 60 billion of capital increases. These front-loaded measures are part of the overall successful outcome of the exercise. Some of the measures taken in 2003 had an impact on what could be detected by the exercise and so reduced the results of the exercise accordingly. And some of the measures taken in 2014 count for the mitigation of the capital shortfalls that were found out. Third point, the comprehensive assessment provides the ECB SSM with substantial information on the banks that will fall under its direct supervision and will help its efforts in creating a level playing field for supervision in the future. And fourth, the repairing of the bank's balance sheets that will follow the results and the resilience revealed by the vast majority of the banks in spite of the severity of the exercise, guarantee that the economic recovery will not be hampered by credit supply restrictions coming from the banking sector, provided that there is enough aggregate demand. I will now go through the slides. If I can move this one backwards. Yes, no. I'm sorry for the glitch. Previous, yes. It's just a moment. Yes. Let me underline the main results of the exercise. Oh, God. A total of 25 billion capital shortfalls were identified across 25 participating banks as a joint result of the AQR and the stress test. The AQR itself resulted in a gross impact on asset values in need of adjustment by 48 billion, 37 billion of which did not generate a capital shortfall. So if you add up the 37 with the 25 capital shortfall, you get the overall impact on the banks of 62 billion coming from the comprehensive assessment. These you can compare with expectations in the market. I just quote two examples of publications by investment houses of September, the more recent ones, of two big investment banks. One made calculations for a sample of 37 banks and found that considering the measures already taken by the banks, the shortfall would be zero, and 3 banks would fail. The other one considered a sample of 34 banks and concluded that taking into account the capital measures taken by the banks in 2014, 0 banks would fail and the capital shortfall would be 0. This compares with our result that out of the 25, 12 banks have already taken measures in 2014 that are enough to cover their shortfall. But there are then 13 banks that still have either to exactly apply their restructuring downsize as it is foreseen in their plans with the European Commission, or they will have to come up with ways to increase their capital. So this is an important explanation of the meaning of the results that we have. In the context of the exercise of the asset quality review, the non-performing exposures of the banks were increased by 136 billion, out of which come, of course, the 48 that have to be adjusted. Another measure of the strictness of the exercise is given by the fact that the combination of the AQR with the stress test results in a drop in the median capital ratio of the banks of 4 percentage points, which is higher than in previous exercises. And in terms of billions, this means that the exercise leads to a decrease of 263 billion euros overall for all the banks, out of which 25 correspond to the capital shortfall, meaning the banks that came below the threshold of 5.5. But this is a measure of the strictness of the exercise, that it had such an impact on the balance sheet of the banks. And it's a usual measure of the impact of such type of exercises, but it's also a measure of the resilience of the system. Because in spite of this drop of 263 billion, the vast majority of banks stayed above 5.5 and were able to support such a shock and still have a capital ratio above the threshold. And let me underline that the threshold of 5.5 is well above the regulatory minimum, because as you know, the regulatory minimum for common equity capital ratio will be in 2018 4.5. So we have chosen a more demanding threshold. And most of the banks were able to resist to such a drop in their capital and stay above the threshold. That's a proof of the resilience of the system, and at the same time, a proof of the strictness of the exercise. This distribution of this drop in the capital ratio, you have it in this slide. I'm not going to comment in detail, just to underline that 75% of the participating banks experienced 0 to 6 percentage points impact on Common Equity Tier 1 under the adverse scenario. Now, the capital shortfall itself, as I said, comes both from the AQR and from the stress test. And the distribution, you have it in this slide, 11.2 from the stress test and 10.7 from the AQR. This is the capital shortfall from the stress test, 11.2. But in the previous slide, you have seen that the drop in capital coming from the stress test corresponded to 182 billion, which is a component of the 263 that I highlighted just now. So this is then the composition. And what I said about the front-loading that the banks have done since July last year is disaggregated in this table. And you see that the overall amount of measures of different kind, they are not just capital measures, but are measures that strengthen the balance sheet and help to clean and prepare the balance sheet for the exercise. Gross equity issuances since then amount to 60 billion. COCOs, or contingent capital issuance instruments that count as additional Tier 1 and obey our conditions, amounted to another 32 billion. Internal capital generation, either by retained earnings or by extra provisions, and we calculated the provisions that are above what would have been the normal trend of evolution of provisions, because indeed, as you well know, since last year, banks have been increasing provisions, just preparing for the exercise. And the two things together amount to 44 billion, and then the other measures, asset sales and others, amount to 67. This is a measure of the front-loading by the banks in preparing for the exercise, which is important to highlight because capital increases or increases in extra provisions done last year indeed reduced the numbers that the exercise could detect in the end. The stress test itself, it's also important to highlight that the severity of the scenario in the adverse case was indeed higher than in previous exercises. In fact, if we compare with previous exercises, taking the metric of the GDP drop in the adverse, after 2 years in this present exercise, the GDP on average would drop by 5.1%, whereas in previous exercises, it dropped by 3 or 4% only. And this exercise had a third year, which was not present in the previous exercises, so that the overall drop in GDP in the adverse over the 3 years comes to 6.6%. So indeed, the whole stress test was more severe also because of other shocks that were considered in the adverse scenario. Just as an example, in what regards the shock in interest rates that the exercise assumes, we had an increase of the yields of sovereign bonds, which in the first year on average was 152, and the second year another 112, and in the third year also 112. You have then the distribution by country in this slide, and what is above the zero is the shock that we imposed in the scenario, an aggravation of the yields of sovereign bonds. And then below zero, you have what happened since last year. And what happened, it was, as you know, exactly the opposite, that the yields dropped a lot, and so the prices of sovereign bonds increased on average by 12%. So this is just another indication of the severity of the exercise in confrontation with what has happened in reality since last year. Finally, just to give you an idea about the drivers that command the impact of the stress test itself alone. Of course, the first three rows in this table show the increase in revenues, which is normal during the 3 years, and then the costs that were affecting the profit and loss account of the banks, and finally the impact on capital. And you have then that, for instance, the shocks admitted on sovereign bonds imply a loss of 28 billion for the banks in the exercise, that administrative costs and other expenses imply a drop in profits and in capital of 865, and that loan losses coming from the assumptions of the stress test on the probabilities of default and the loss given default of the credit portfolio of the banks imply a loss of 378 billion. And that's how you reach 181, and the difference with 182 that I showed before is just a matter of approximation. It's the same figure, and this is the disaggregation of the figure. So this really shows that the exercise was indeed quite strict. It was implemented by officials and private experts, and the results, as I said, guarantee that going forward, the economic recovery will not be hampered by credit supply restrictions. Thank you. And now, well, you lead.
Thank you, Victor. Following up on Victor's explanation on the stress test, let me now highlight some key findings from the asset quality review. As you see on these slides, the AQR resulted in gross adjustment of 48 billion. You may be aware that this AQR was a process that stretched over almost 10 months. Its execution consisted of 10 specific work blocks that examine a variety of aspects, each of them very relevant of its own right and necessary to generate robust overall results. I will not try to cover the whole of this massive process on each single work block in my comments here. That will be simply impossible. Instead, I would like to focus on some high-level findings that represent key results of the exercise at an aggregated level. The chart on this slide shows how different components of the AQR, oh, sorry, I have moved. Okay. So this chart shows how different components of the AQR contribute to the overall adjustment. This AQR review bands exposures in two ways, on an individual credit file basis, and for smaller, more homogeneous exposures on a collective basis. The first of these approaches was reflected in the credit file review, where a total of around 119,000 of the riskiest debtors in the riskiest portfolios were analyzed individually. The ultimate purpose was to verify that an appropriate provision level had been set against each debtor. You can see in the chart that this part of the AQR led to a 15.4 billion increase in provisions. This change in provisioning levels was then projected to the unsampled debtors in the portfolio for whom no credit file review was conducted. and the projection led to an additional 10.3 billion adjustment to provisions. In contrast to the file-by-file approach reflected in the credit file review, smaller, more homogeneous exposures are typically provisioned using a collective provisioning approach. In this collective provisioning work block, we thus review the outcomes of banks' own statistical model, and where they were not deemed conservative enough according to our methodology, an adjustment to provisions was calculated in total. This led to an adjustment of 16.2 billion. Finally, we also reviewed exposures held at fair value, which were not covered in the work blocks mentioned previously, and this led to another adjustment of 4.6 billion. Overall, we thus arrive at a total adjustment to asset carrying values across all banks of roughly 48 billion. Since such adjustments have negative effects on banks' profit, of course, they lower the amount of tax to be paid. So taking these tax effects into account, 14 billion, we arrive at a net impact from the AQR of 34 billion. Let me now say a few more words about an important component of the credit file review, namely the assessment of loan performance. At the start of the exercise, it was known that participating banks' definition of which exposures are performing varied significantly per bank and per country. As part of the AQR, the ECB thus imposed a standard definition of non-performing exposures across all banks using an approach agreed with the EBA. Let me emphasize that this represents a major step forward in terms of comparability across banks and countries. The harmonization of the non-performing exposure definition was crucial to ensure a consistent treatment of debtors being reviewed and allowed to set a level baseline against which debtors could be assessed. As a result of this harmonization, and because banks' internal definitions were generally less conservative than the definition used by the AQR, 55 billion euros of additional non-performing exposures were identified at the outset of the credit file review. The credit file review itself and the subsequent projections of finding led to the identification of a significant additional stock of non-performing exposures amounting to 81 billion. Together, the harmonization of the definition on the credit file review itself thus led to a total adjustment in non-performing exposures of 136 billion. And this represents an 18% adjustment to the initial non-performing exposure stock reported by the participating banks. Now, provisioning adjustment. As you see on this slide, they were totaling 43 billion across all asset segments. The assessment of provisioning levels was indeed the next step in reviewing banks' classifications of exposures into performing and non-performing. As mentioned, this assessment resulted in a total provisioning increase across all segments of 43 billion, which is a 12% increase. Looking at the main asset segments for which those adjustments were made, we find that they were primarily driven by exposures in the large SMEs, large corporates, and real estate-related segments. Those exposures saw additional provisions of 12 billion, 9.5 billion, and another 9.5 billion, respectively. I should also add that the collateral valuation work block, which we conducted, was also an important input in calculating these adjustments. Across, the SSM collateral values were adjusted downwards by 39 billion, representing an approximative 10% decrease compared to previous banks' internal valuation. The three categories of exposures I just mentioned were indeed particularly impacted by the collateral valuation. I can also add that shipping assets saw the largest relative increase in provisions, amounting to 28% of the previous stock, and this reflects an increase of 2.6 billion. I think the aspects I show on those last slides are important to understand what the actuary did and where the adjustment to asset values that constitute its ultimate result come from. As pointed out at the beginning, this was a very rough summary of a very complex and a huge process, and there are many additional aspects and findings that I would like to mention, including quite a few which are not purely quantitative, but relate to banks' processes and policies. But in the interest of time, let me now get back to a brief look at the overall capital shortfall identified in the comprehensive assessment before I conclude with an outlook of the main steps following today's publication of the outcome of the comprehensive assessment. So, this is an overview. I'm sure you cannot read the slide, it's too small. This is an overview of the 25 banks for which shortfalls have been detected. You can find it in the executive summary of our aggregate report. As you can see, 12 of them have already raised enough capital in 2014 to cover their shortfalls completely. And this leaves us with a net amount of slightly over 9 billion that still need to be covered. This being said, the immediate next steps for banks and supervisors are focused on capital planning. Those banks for which we identified a capital shortfall will have to submit capital plans by 10 November, in which they show in detail how they plan to cover those shortfalls. The joint supervisory teams in charge of the daily supervision of those banks, starting as of 4 November, will check those capital plans thoroughly, assessing their adequacy and credibility. As we communicated already in April this year, banks with shortfalls identified in the AQR or in the baseline scenario of the stress test will have 6 months to implement these plans and cover the shortfalls starting from today. Where shortfalls arose from the adverse scenario, banks have 9 months to do that. While these actions on capital plans are only relevant for banks with shortfalls, there will also be a wider range of follow-up actions concerning all participating banks, the banks which have a shortfall and the banks without shortfalls. This will include adjustment to accounts where breaches of accounting rules were found or where accounting provisions were not enough, but also Pillar 2 measures for the prudential elements. As I mentioned earlier, the AQR findings were also not limited to quantitative aspects, but included a number of issues concerning processes and policies, and that will be used as well in the supervision going forward. With this short outlook on what is next for banks and supervisors, I would like to close. I think that we have achieved a lot in this comprehensive assessment, but at the same time, it is just the starting point for our new task under the SSM. We will take those on with the clear objective of conducting tough, fair, and independent supervision on a day-to-day basis, and I am very much looking forward to the formal start of our new responsibilities on 4 November. Thank you.
Thank you, Madam Nouy. So we'll come to questions now. I would appreciate if you could identify yourselves and your media affiliation. And if you want to direct questions to one or the other, please say so as well. We start with the lady here in the third row.
My name is Annette Weisbach. I'm with CNBC. So my question would be on how credible these tests are. Looking at the adverse scenario, you haven't even included deflation. You have not included a hold in gas imports to Europe. You have not included full-on sanctions on Russia. So please elaborate and convince us.
Well, the scenario for the stress test was published earlier in the year, so some of the things you mentioned could not have been considered. But indeed, what was considered is a severe shock in the growth of other countries. If you look to the scenario, you see that for the US, there is also a big deceleration of growth, which is part of the scenario, and also for other countries that are the markets of the euro area. So that is embedded in those assumptions of indeed a big drop in external demand directed to the euro area. That's the first point. The scenario of deflation it's not there because indeed we don't consider that deflation is going to happen, but let me highlight that nevertheless, whereas the baseline scenario, which is in the stress test, has inflation at 1.6 in 2016, in the adverse it comes down to 0.3. So this drop in inflation is indeed factored in the exercise and is a very significant drop. So it cannot be said that we did not consider the impact of a scenario of very low inflation. Indeed, we did it in comparison with the baseline. So, of course, new shocks can aggravate the situation, but some of the shocks that we considered did not materialize, which may offset the impact of new shocks. What is relevant is that the set of shocks that was considered was severe enough to have an impact on the capital of the banks by minus 263 billion, which is not negligible and includes and proves that the banks would be prepared to support such a drop in capital, and still most of them stay above 5.5, and that's what counts.
Thank you. Gentleman in the second row here.
Good afternoon, Jeff Black from Bloomberg News. My first question is for the Vice President, and my second for Ms. Nouy. In the footnotes to the results, am I right in thinking that the two Greek banks that were shown to have shortfalls, if they're considered on a dynamic basis, a dynamic stress test basis, they're essentially done. They're in the clear. They don't have anything else to do. I just wonder if you could confirm the situation for the Greek banks. And then my second question for Ms. Nouy, perhaps you could just say a little bit more about what we can expect going forward. For the banks that have just scraped through, are you going to be pushing for higher provisioning as a general point? And could you maybe just elaborate on the divergence of transitional arrangements to adjustments to CET1? Are you trying to harmonize and improve capital quality?
The answer to the first question is yes, because as you know, the exercise according to EBA methodology was done on a static basis, meaning that the balance sheet cannot change during the horizon of the exercise. But that's why I said that 12 banks already had taken measures that cover the shortfall that they had, and the other 13 had either to comply with their restructuring plans, which is the dynamic exercise, or to find ways to increase their capital. So I was very careful in portraying what is indeed the meaning of the split between the 12 banks and the 13, part of which indeed have to prove that they will comply with their restructuring, which implies downsizing, and then the possibility, indeed, of coming up without a shortfall in the end.
Well, regarding the second question, the priority is obviously to fully implement the comprehensive assessment. It starts with the capital plans for the banks that have a shortfall. Indeed, we will follow up with all the weaknesses that have been detected, identified in the comprehensive assessment. It can be passing just, but it also can be too long to deliver data when requested. That can mean IT weakness, maybe. We got a lot of information, all kinds of information, quantitative and qualitative, from the exercise, and we will use all the elements of the information that we received. Regarding the definition of capital, indeed, we are in a transitional period, a phasing period towards full CRD4 CRR. We have to follow the trajectory of the banks towards full implementation, and we will work on increasing as much as possible the consistency of the definition of capital that will be used. And that's a possibility with the choice of the national options for the ECB, because soon we will be the national competent authority, and this is the national competent authority that decides about the national option. So we have work ahead of us, and we will start that almost tomorrow, now that one exercise is completed, and we have a lot of information to build on this exercise.
The lady in the third row here, please.
Thank you, Eva Taylor from Reuters. You said that you're quite confident that as a result of this exercise, lending will now pick up. And I was wondering, what makes you so confident, considering the depressed economic scenario that we're having at the moment, and that demand is actually quite weak for loans? And my second question concerns the capital requirements, which seem to have been somewhat weaker than some of the investors had expected. So does this mean, on the one hand, that either banks were a lot healthier than we all thought, or could this lead to a similar scenario as we had after the previous tests that failed to reach the credibility that was desired? Thank you.
Thank you. On the first question, I will repeat what I said, which was that with the repairing of the banks that have a shortfall and all the others having been able to stay above the minimum, this means that the economic recovery will not be hampered by credit supply restrictions coming from the banking sector, and I said, provided that there is enough aggregate demand. So I already mentioned exactly what was implicit in your question. I didn't say at any moment that lending is going now to become very buoyant, because it does not depend only on credit supply restrictions. It depends very much on demand, and I said it in my statement. And that then means that I agree with the gist of your question, and I already preempted the question. On the second point, yes, the starting point was very important, because it's important to underline that the starting point of these 130 banks had a capital ratio, common equity, of 11.9, which we approximated to 12%. That's very high. Let me remind you that the regulatory minimum just now is 4. They have 12. So that's why they were able, indeed, to sustain a big drop coming from the exercise. But that's just an indication that, indeed, they were healthier and more robust than many analyses that have been done in the recent past. Those are the numbers, 12%, or 11.9 if you want to be very precise, as the starting point. That explains certainly the results. It also is partly explained by the fact that banks did actions last year which already are then included in the starting point precisely, and that's why it is why the starting point was stronger than what the banks had in 2012. That's very important because it was an anticipation of the exercise, which is good, but it must be seen as part of the success of the exercise, of course, because it would not have happened if they didn't know that this exercise was coming. Then, comparing these with expectations, I quoted the more recent ones from two big investment banks, one German, one American, and where when they counted themselves for their sample, which was much smaller, as I said, when they counted what the banks had already done, one found that 3 banks could fail, and the shortfall could be 2.7 billion, and the other one found 0 in both cases. No bank would fail, and 0 capital shortfall when they took into consideration what the banks had done. So these are things that were published in September, though very recent calculations, simulations, which I think compare well with the result that we just presented.
Second row, yeah. Sorry.
Thank you. Bernardo de Miguel from Spanish newspaper Cinco Días. A question for the Vice President. If the banks are so healthy as you claim, how do you explain that there is a lack of credit, or a credit very expensive in some part of the Eurozone, even for sound demand? And how do you explain that you had to provide the banks for the last 3 years with plenty of liquidity and measures to help them to provide interbanking lending? Thank you.
Okay, in what regards liquidity, what we did in 2011, beginning of 2012, at that moment, there was a very stressful situation of lack of liquidity for banks in Europe. Both in the bond market and other debt instruments, the banks had difficulty to issue at that particular moment because, remember, it was when the double dip in Europe started in late 2011, and as a result, there was almost a freeze in the market for bank debt, and that's why we provided the liquidity. Then, since mid-2012, it was clear that that situation had eased, and the banks then started to repay those loans much earlier than they had to do. So the situation of liquidity since then has not been an obstacle to any credit decisions. Now, what has been a restriction, and we recognize that from the start, is that this exercise, of course, led the banks to be very careful in what they were doing with credit and with possible expansions of their balance sheets. They wanted to be as prepared as possible to pass this exam. And we said it from the start that unavoidably our exercise would have a procyclical effect on the economy. And indeed, it happened. But now it's over. And the banks will be certainly much more comfortable to take decisions. That's one thing, which is important. But as I said, the absence of credit supply restrictions because the banks would lack capital or liquidity are not enough to ensure that the credit will grow, because it is also a question of demand, and there is indeed a lack of aggregate demand in Europe. And in what regards the cost reflects mostly now the degree of credit risk in different parts of the euro area. Of course, in countries where the economy is not performing so well, the credit risk is higher. And so the banks have to take decisions, also taking into consideration the credit risk for their decisions. And that's, of course, very important and explains part of what is going on. But it is for sure that the end of this exercise will put the banks in a much better position. Also, it's not a question of liquidity, because, again, for other reasons, reasons of monetary policy, we decided to now have this new facility of targeted LTRO. And that's for monetary policy. It has nothing to do with the problems of the banks. This time, it was not because of a stress situation of liquidity, as it was the case in 2011, and we acted then as the lender of last resort, which is a normal function of the central banks. This time, that's not the reason. It's a pure monetary policy measure, because we want, indeed, that our balance sheet expands, that we want to use other channels of transmitting an expansionary monetary policy, that it is totally justified in the present environment of low nominal growth.
Let's go to the back of the room. There's a lady there. Just a second. Hold to the microphone. Thank you.
Judith Festas, German ARD Radio. How easy or difficult do you think it will be for the banks who have a capital shortfall to raise the 9 or 10 billion capital? And do you see a possibility of governments having to jump in and find, in case there's no private?
Well, it's difficult to tell, and we won't speculate on that. Now it's for the banks to come up with their plans to cover those for shortfalls, and they have 2 weeks to present those plans, as Madame Nouy just explained, and then these will be assessed, and the SSM will stand ready to work with the banks in order to ensure that the shortfalls will be covered and implemented in the time frame that was defined by the exercise, meaning 6 or 9 months. And that's what we have to say. We have to wait to see what the banks will tell the market. We are sure that today or tomorrow, many of those banks will come up with their plans to the market. I don't know if Danielle wants to add something on this question.
No, it's the work that will start in the following days. We have started talking with the banks and the national competent authorities, but review of the capital plan is not yet done.
Second row here.
Hi, this is Claudio Perez from the Spanish daily El País. Can you explain why the inflation in the adverse scenario is at 1% this year, if the current data is at 0.3, and in April, when the exercise was designed, it was lower than 1%?
Yep. Well, first, in April, it was still foreseen by many institutions, including us, that inflation for the whole year would be around 1. So that's one explanation. The second explanation is that the stress test is not a forecast. And by the way, the stress test was published in April, but was designed some months before. That's another point that you have to have in mind. But the stress test is a scenario, it's not a forecast. Because if it was a forecast, for instance, we wouldn't have put in that the yields of sovereign debt would increase. We knew that they were not increasing, and indeed, as I showed in that slide, they have decreased a lot. So again, the stress test scenario is not a forecast. And at that time, nevertheless, when the scenario was built, the general forecast was for inflation this year around 1. Then it came to surprise that inflation continued to decrease, but that was after the fact. Nevertheless, we had, as I explained already before, a big difference between the baseline and the adverse, taking into consideration the impact of a big disinflation.
Let's go to the back of the room there. The gentleman in the fourth from last row. Yes, yes.
Hello, Sjoerd en Daas, RTLZ from Holland. I have a question. The banks have received basically the results on Thursday. How fluid have they been in the meantime? I mean, how do they differ from the eventual final results? Has there been any space, any room to either comply or explain? For the Vice President first, please.
Well, it depends very much. Sometimes there were factual errors that had to be corrected, not the right line, not. So there were corrections. Were there significant? Most of the time, no, but they had to be corrected, and it's a quality. It's part of the quality assurance as well to listen to the banks if they believe that this is not giving an exact, accurate picture of the situation.
I will add, nevertheless, as Madame Nouy just hinted, that in those 48 hours, these corrections were absolutely minor. So they are negligible in what regards the big numbers of the exercise. So it's an important assurance. They did not change materially overall. So it was just minor corrections that happened, which is why precisely we gave the full results to the banks 48 hours in advance for that reason.
Jack Ewing from the New York Times. A question perhaps for Madame Nouy. I'm wondering, in the course of doing this, you learned some things about the banking system that you're going to be looking more closely at now that you're the single supervisor. You mentioned possibly some banks have problems with their IT. Are there any other issues, assets that they're overly exposed to, any types of sort of red flags that you're going to be watching in the future? And then a second question, how much of the adjustment in provisions and the revaluation of assets was because of sort of technical factors, because you were harmonizing all the standards, and how much was simply because the banks had been over-optimistic about the value of what they had? If you can give us any sort of rough idea about that. Thank you.
Well, as a matter of fact, I don't want you to believe that I said banks have IT problem. I took the example of IT for mentioning that we will build on any kind of information that we received, and not only the quantitative information on capital or provisions, because it is important to know as well. The adjustment were, to a certain extent, indeed related to the harmonization of the definition of non-performing exposures. It's a major step forward because for a number of years, these had prevented EBA, for example, on us to fully compare the situation of the banks in this respect. So it was very crucial to have consistency in this definition. Then the banks will, to what extent the banks will adjust their provisions. Certain adjustments are accounting adjustment. For example, in the accounting definition, you cover incurred losses. This is what has to be covered. But there is also a prudential dimension. For example, for the banks that use models to calculate risk-weighted assets, they have to make sure that they cover expected loss, which is more than the incurred losses. It goes beyond incurred losses. So this will be addressed through supervisory actions on work. At the end of the day, we want really to use the incredible amount of information that we have gained through this exercise. We never had such an in-depth knowledge of all the banks of the SSM area. And we will build on that for the capital plan, for the 2015 program of supervision that we will have to prepare before the end of the year.
Thank you. Lady in the next to the gentleman who just asked the question. Thank you.
Claire Jones, Financial Times. First question, you noted that there's now a common definition of non-performing loans, but I'd also like to get a sense of you of how much regulatory and supervisory convergence still needs to happen post this exercise. Secondly, the Banca d'Italia seems to be saying of the 9 banks that failed, only 2 have not taken sufficient action this year to now have covered the capital shortfall, whereas your results seem to suggest that there's still 4. So, I mean, would it be possible for you to perhaps explain these differences and say, you know, how does that influence the process of what those 2 banks are supposed to come up with over the next 2 weeks and so on and so forth?
Well, regarding harmonization of regulation, that's definitely something that should happen. In order to deliver consistent supervision, we need consistent regulation. The current period is not the best possible one for that, because we are in a phasing period for implementing the CRD4. And there are national options in this phasing as well. So that's an issue. There are some issues regarding national options outside of the phasing, and that will have to be addressed over time as well. And for the second part of the question, I would say that this exercise was not about the number of banks that would fail, but was about transparency and full knowledge by the investors about the content of the balance sheet of the banks. That was this accurate part. Also, capacity of the banks to sustain a significant deterioration of economic and financial condition, and this has been delivered through the stress test.
In the back there, please. Oh, sorry. The Bank of Italy. The question.
ARD German television in Frankfurt. I'm sorry.
Sorry.
On the Bank d'Italia issue about, they seem to be saying 2 of the 9 banks still need to take action, whereas you seem to be implying that 4 still need to take action. So how can this discrepancy be explained?
As of 2013, they have shown certain weaknesses, but certain of those banks have already covered their shortfall, also, which is very encouraging. Also, we can note that the reasons, the trigger of the shortfall is in the adverse scenario of the stress test most of the time. And as we believe that those are tough stress test on tough scenario, the probability of occurrence of those scenario is not big, probably will not happen. And they have time now to come with a credible, sound capital plan. We will see, we will have an assessment after reviewing the capital plan.
Yeah, if I may add something to one aspect of your question. We don't know what Bank of Italy has meanwhile said, but I can assure you that they are fully aware of the results, that the results are the same, that the results are the ones we just published, which indicate which banks have a shortfall, 9, and the ones that we have already accepted the measures that they have taken in 2014 to cover those shortfalls. And there is no difference whatsoever in what regards these numbers between ourselves and Bank of Italy. So the rest, of course, is certainly, I can only now try to speculate a bit. The only other problem may be about the type of measures that Bank of Italy is already thinking about for the banks to take. But no difference whatsoever in what regards the results of the exercise.
Yeah, indeed.
Yeah.
Let's go to the question in the back, please.
ARD German television in Frankfurt. Mr. Vice President, please let me come back to your assessment that you see no problem for the credit supply as a result of this assessment. I'm a bit puzzled about this statement, because if I have been listening correctly to your president, the president of this House, I have been hearing something completely different over the last months, which also explains the extraordinary measures which have been taken on the monetary side. Would you please elaborate on this contradiction, please? And Madame Nouy, please allow me a second question. Madame Nouy, if I see that nearly 1/5 of the banks have not fulfilled the requirements which they should fulfill,
I feel that it is quite a worrying situation we're having in the banking system in Europe. Would you please explain to the normal person on the street how serious the situation indeed is out of your view? Thank you.
On the first question, there is no contradiction, or rather the contradiction may be yours, because indeed myself and the President are saying the same. The measures that we have taken are mostly to address the situation of weak aggregate demand in the euro area, which is part of the explanation why inflation is so low, which is our mandate. This is the motivation for those measures. You have only to read the speeches of President Draghi to see that's what he is talking about, and it's very clear. We are worried that there is not enough real growth, and as a result, there is a big slack in the economy, and the big slack in the economy impacts downwards the inflation rate. And that's what we are trying to change with the monetary policy measures that we took. And as I underline, all the measures, including the targeted LTRO, are directed to this objective. It's a pure monetary policy decision. It has not to do with any sort of difficulty in the banks, because indeed, one of the reasons why there is no stigma in banks coming to this facility is because everyone knows in the market that they are not pressed for liquidity just now. So it's a monetary policy decision, because we think that we have to explore, in such a challenging situation, we have to explore new channels of transmission of expansionary policy. So it's about having a expansionary monetary policy in such a situation. It has nothing to do with credit supply. Yes, if aggregate demand will respond to the measures, then demand for credit will increase, and now the banks will be in a more comfortable position to respond to that and to support the recovery. And the two things together, the end of the comprehensive assessment and our measures, will certainly have a positive effect on the overall situation. So no contradiction.
Coming out of this exercise, we have now, out of 25 billions, more than 15 billions that are already covered. So I don't see anything there that makes it particularly challenging for the banks that have an effort to do. I cannot tell more at this stage because I have not yet reviewed the capital plan of these banks. But this is certainly, there are solutions, and the banks, with in a dialogue with their supervisors, national supervisors, and ourselves, SSM supervisors globally, they will find solution. I have no doubt about that.
Yeah. Right. Sure.
Okay, so we have one more last question here in the middle, please.
Yes, Jarko de Zwart, Dutch newspaper De Telegraaf. I don't know who to ask this, but just for the matter, what can you tell all the depositors of the banks that have failed these tests and show capital shortfalls? Should they go to their banks and withdraw their money tomorrow, or what assurance can you give them?
The shortfalls will be fixed under the calendar which has been provided, 6 months if it's the baseline or the AQR, and 9 months if it is the adverse scenario of the stress test. And we will know more on the way this will be fixed in 1 or 2 weeks. Again, this is not something that is not doable, not at all.
Yeah. One objective of the exercise was precisely to repair the situation of banks that could show a weaker result, and that's what will happen in the near future.
Thank you very much for coming on a Sunday, and the presentations will also be on the website, so you can look at them there. Thank you very much.